So, you're looking to really get your head around VA loan credit underwriting, right? Not just scratching the surface, but, properly understanding what goes into those decisions. You want the info, but maybe you don't have time to wade through like hundreds of pages of regulations.
Well, consider this our mission for this deep dive then. We've basically boiled down Chapter 4 of the VA Lender's Handbook. That's the core section on credit underwriting. Think of it as your shortcut to the really important stuff.
Exactly. We're pulling out what lenders are really looking for when they size up a veteran's credit for a VA loan.
And it's a pretty broad topic, The handbook covers, everything. General principles, income analysis, which is huge, obviously, for all kinds of jobs. Then taxes, assets, debts, the credit history itself, and even those automated systems they use now.
Right. But the main takeaway, the big picture idea, is that it's all geared towards helping qualified vets get homes, isn't it?
Absolutely. It's about ensuring they're a satisfactory credit risk, yes, but also providing that support they've earned.
Okay, great starting point. So let's jump right into those core underwriting principles then. What are they?
Well, what's interesting right off the bat is that the VA actually tells lenders, they encourage them to make loans to all qualified veterans. The standards aren't meant to be rigid rules, they're more like guidelines. Lenders need to use sound judgment and, importantly, be flexible.
So it's not just a checklist exercise?
Not at all. Fundamentally, there are two main legal things. The vet needs to be a satisfactory credit risk, and, there needs to be a proper fit between their income and the loan terms. They need to be able to afford it.
Makes sense. The basics. So what are lenders actually on the hook for in this process?
Oh, quite a bit. They have to gather all the info to build that credit picture. That means getting verifications, employment, bank stuff, pulling credit reports, the works, and accuracy is key. They have to make sure the info they base the decision on is solid. Plus, obviously, follow all the laws, regulations, and the VA's specific rules.
And in this day and age, I guess digital signatures are okay, like e-signing?
Oh yeah, absolutely. The e-sign Act makes them legally the same as signing with a pen. So when a lender starts this whole process, what are the first couple of steps they usually take?
Okay, well, first up, they'll run checks through the VA system and also CAIVRS.
CAIVRS. Yeah, that's the Credit Alert Interactive Voice Response System. Super important. Think of it as a national check to see if the borrower has defaulted on any federal loans before.
A sort of red flag system for government debts.
Exactly. And at the same time, they're gathering verifications. A really key one is the Veteran's Certificate of Eligibility, the COE. That confirms their entitlement amount, funding fee status, and any disability income.
Right. And there's that specific VA form they have to fill out, isn't there, for the analysis?
Yep. Usually VA form 266393, the loan analysis form. They complete that as they go through the application and all the documents. Any special notes or explanations go on there, but there's an exception for most IRRLs.
IRRLs, interest rate reduction refinancing loans, the streamlined ones.
That's them. Yeah, they're usually simpler, so that form often isn't needed.
Okay. Now, these underwriting rules we're talking about, do they apply the same way to all VA loan types?
Good question. Mostly what we're digging into here applies to your standard purchase loans and cash-out refinances. Chapter 7 of the handbook actually has specifics for other types, and for refinances like those IRLs, again, usually no underwriting unless the current VA loan is delinquent. If it's, say, 30 days past due, then yeah, it needs prior VA approval to make sure things are sorted out and the vet can handle the new payment.
Got it. Okay, that sets the stage well. Now let's dive into maybe the biggest piece of the puzzle, income analysis.
Absolutely crucial. The underwriter's job here is basically to confirm the borrower has enough reliable income. Enough for the mortgage payment itself, sure, but also other housing costs, existing debts, and just, day-to-day family living expenses.
And it's not just the dollar amount, is it? It's about how steady that income is.
Exactly. It has to be what's called effective income, which means, 1, it has to be verifiable. You need proof. 2, it needs to be stable and reliable, so likely to continue. Like a one-time bonus might not count, but a regular salary probably will.
So their job history is a big clue then.
Definitely. Lenders look hard at past employment, training, education, what qualifies them for the current job, the type of work it is. But bottom line, only verified income gets counted towards affording the loan. And it's not, a cookie cutter thing. It takes judgment, flexibility for each person's situation.
Okay, what about a spouse's income? When does that come into play?
Right. Spousal income needs the same verification treatment as the veterans if the spouse is going to be legally on the loan, or if the vet is relying on that income to qualify, or if it involves alimony or child support payments being received. And there are also special rules for community property states.
Ah, community property. How does that change things?
Well, in those states, the lender can ask about and consider the spouse's income just like the borrower's, even if the spouse isn't signing the loan documents. But you always have to remember EPOA.
The Equal Credit Opportunity Act, the anti-discrimination law.
That's the one. EPOA says lenders can ask about spousal income unless one of those specific situations applies: obligated, relied upon, alimony, child support, or community property. Also, borrowers don't have to disclose alimony or child support income.
But if they want it counted, they need to provide it, right?
Exactly, and then the lender verifies it. Crucially, you can't discount income because of sex, marital status, age, race, anything like that. And one more point. Even if a spouse isn't buying, their debts still get factored in generally for the household financial picture. Their credit history usually isn't needed, though.
Okay, important distinction. Let's switch gears to income from regular, non-military jobs. What's key there?
Generally, lenders like to see at least 2 years of employment history, 2 years with the current employer. That's seen as a really strong sign of stability.
And if it's less than 2 years currently?
Then they'll usually need to verify prior jobs to get that 2-year total. If they really can't document 2 full years, the lender has to explain why. They'll also cross-reference things like the VOE, pay stubs, W-2s, tax returns to make sure it all lines up, and there aren't big discrepancies affecting qualification.
How do they actually get that verification?
They've got options. They
Yeah.
can use services like the work number, provided it gives all the same info as a standard verification of employment, or VOE, things like hire date, job title, pay rate, frequency, year-to-date earnings, overtime, bonuses, all that stuff.
And if they use that service, maybe no pay stub needed.
Right. Or they use the standard VA form 268497, the VOE form, or something equivalent. That VOE original fax email usually needs recent pay stubs too, covering the last 30 days, showing year-to-date earnings. And these documents can't be too old, generally 120 days max from closing, or 180 for new construction.
What about people in, say, construction or seasonal jobs? Is it different?
Yeah, a bit more needed there. For building trades or seasonal work, besides the usual VOE and stubs, they'll likely need proof of year-to-date earnings, signed tax returns for the last 2 years, and maybe union membership proof, if that's relevant.
Are there times when they might accept something besides the standard VOE, like an alternative?
Yes, sometimes. It's called alternative verification documentation. This can fly if the lender feels confident the income is stable, reliable, and likely to continue, even without 2 years at the current job. It usually involves recent pay stubs, W-2s for the last 2 years, and maybe a phone call to verify current employment.
A phone call.
Yeah, but they have to document who they talk to, when, their title, number. But here's the catch. If the employer won't verify over the phone, or if anything seems fishy, then you must get the standard, full VOE. No alternative option then.
Okay. What if someone's been at their job less than a year? Is that income just unusable?
Not always. Look, less than 12 months makes it harder to call it stable, obviously. But lenders can make exceptions if the whole picture makes sense. They'll look at past jobs, training, education. Does it relate? Does it suggest they'll likely stick with it?
So context matters.
Huge context matters. If they use income from less than 12 months, it needs a really clear explanation on the loan analysis form. Sometimes, even if it's not stable enough to qualify initially, if they hit the 12-month mark later, it might help offset short-term debts. And a verified job offer starting soon after closing. That can also be considered, even without pay stubs yet.
What about people who seem to hop between jobs fairly often?
Yeah, frequent changes, especially with short time in the current role, means a closer look at stability. Lenders want to know why the changes happen.
Like, is it career progression?
Exactly. Moving up in the same field looks better than, say, jumping between totally unrelated jobs. If it doesn't show a clear positive pattern, stability is harder to argue. And again, if they do count income from a short-term job in that context, they have to explain why on the VA form.
Makes sense. Now, lots of people have income from overtime, part-time work, second jobs, bonuses. How's that viewed?
Generally, that kind of extra income needs a solid 2-year track record to be considered stable for qualifying. You need that history, plus a reasonable expectation it'll continue.
So consistency is key again.
Consistency and likelihood of continuation.
Yeah.
They'll look at how it fits with the main job, how long they've been doing it. Now, even if it doesn't hit the 2-year mark for qualifying income, if you can verify it for at least 12 months, it can be used to help offset debts that have, say, 6 to 24 months left. But, you guessed it, needs an explanation on the loan analysis form if used that way.
Okay, let's tackle commission income. That can be pretty variable, can't it?
It definitely can. For commissions, you need verification from the employer showing the year-to-date amount paid, the basis for payment like salary plus commission, straight commission, draws involved, and how often they get paid. Plus, usually signed tax returns for the last 2 years, sometimes more.
And the stability rule, still 2 years.
Generally, yes. 2 years of earning commissions suggests stability. Less than 2 years might work if they have strong related prior experience or training. But less than 1 year on commission. That's rarely seen as stable without some really deep digging and justification.
Any quirks with commission expenses, like on tax forms?
Ah, yes. IRS Form 2106 expenses. Unreimbursed business expenses. If commission is less than 25% of their total annual income, those expenses don't have to be deducted. But if commission is 25% or more of total income, then yes, those 2106 expenses must be subtracted from the gross commission income. Doesn't matter how long they've been claiming them.
Except for car payments.
Right. Car lease or loan payments listed there are always treated as a regular monthly debt.
Got it. Okay, self-employment. That always seems to require extra scrutiny. What docs are needed?
Yeah, it's more involved. For self-employed borrowers, you need current financials, usually a year-to-date profit and loss statement, maybe one for the prior year if taxes aren't filed yet, and a current balance sheet. Plus, signed individual tax returns, all schedules for the last 2 years, maybe more if needed to show stability.
What if it's a corporation or partnership?
Then you also need the signed business tax returns for the last 2 years, again with all schedules, and a list showing who owns what percentage. These financials need enough detail for the underwriter to really understand the business. A YTD P&L covering at least half the year is helpful. Sometimes if it's complex, they might even require statements prepared or certified by a CPA.
And stability.
Yeah.
Still the 2-year guideline.
Generally, yes. 2 years self-employed is the usual benchmark for stability. Less than 2 years might fly with strong related prior experience or training. Less than 1 year. Very tough. Needs intensive review to show it's likely to succeed. Lenders also look at the income trend. Is it declining? If so, why? Is that likely to continue? If the future looks murky, they might need more info. Maybe expert opinions on earnings potential.
Are there any specific things to watch out for when analyzing self-employment income?
Yeah, a couple of key ones. Depreciation, that non-cash expense on tax returns, that can usually be added back to their effective income.
Oh, interesting. So that helps boost income.
It can, yeah. But business losses are also looked at closely. On a joint return, if either the borrower or spouse shows a business loss, that loss amount gets deducted from the borrower's income. Doesn't matter if it's a community property state or not.
So a loss from one spouse affects the other's qualification.
It can. Sometimes, if both have losses, it might actually make sense for both to be on the loan application so their full profiles are considered.
Right. Okay, let's shift to active military income. What's the military version of a VOE?
That would be the leave-in earnings statement, the LES. It serves the same purpose. Needs to be an original, a certified electronic version, or a lender-certified copy. Same key info, same age limits, 120 days generally, 180 for new construction. Now, a really critical thing with military borrowers is identifying anyone within 12 months of leaving active duty or their contract ending.
The ETS date, expiration term of service.
Exactly. It's right there on the LES. For Guard and Reserve on active duty, you look at both their tour end date and their overall ETS. If any of those dates are within 12 months of closing, you need extra documentation.
What kind of extra docs?
Could be proof they've already re-enlisted or extended their service beyond that 12-month mark, or a verified civilian job offer lined up locally, or proof of military retirement income starting soon after release. Another option, a statement from the service member saying they intend to re-enlist, plus confirmation from their CO that they're eligible and likely to be approved.
So confirmation of future plans, essentially.
Right. Or, finally, really strong compensating factors. Things like a big down payment from their own funds, lots of cash reserves, or strong community ties combined with a high non-military spouse income that reduces reliance on the military pay.
Are there exceptions to needing this extra stuff?
Yes. For officers whose LES shows an ETS date like 888-888 or 00000, that usually means indefinite service. No extra docs needed then, unless there's proof they've actually resigned their commission. When looking at base pay, it's generally stable unless they're in that 12-month window. Then you scrutinize that extra documentation to ensure future income stability or that those compensating factors are really strong.
What about all those military allowances, BAH, BAS, etc.? Can those count as income?
Yes, many can, if verified properly. BAH, the housing allowance, is tax-free. Need to verify the amount for their duty station and that they meet occupancy rules. BAS, the subsistence allowance, and clothing allowances are also tax-free and can be included. Convert the annual clothing allowance to monthly.
Okay. What about things like proficiency pay or combat pay?
Those can count to proficiency pay, overseas pay, combat pay, but you need to verify the type, amount, how long they've received it, and crucially, if it's likely to continue. These can change with assignments, so if there's doubt about continuation, the lender might need clarification from the command. If you can't confirm the duration, maybe you can use it just to offset shorter-term debts instead of counting it as core income. And always good practice to double-check with the IRS on the tax status of specific allowances.
How about income from the reserves or National Guard? How's that handled?
That income can be counted if their service history suggests it's likely to continue for at least the next year or so. Total time served, active and reserve guard helps assess that. If long-term continuation isn't clear, again, maybe use it just to offset debts with 6 to 24 months left.
What if someone's just been activated for a short time?
Good point. Need to see if their income changes. If they're activated for, say, less than a year and their regular civilian pay is lower than the temporary active duty pay, you generally use the lower, more stable civilian income for qualifying. It's really case by case. Look at the whole picture credit, assets, job history, and document the reasoning carefully. Goal is sustainable home ownership.
Okay. And veterans who've recently left active duty or are transitioning out, how's their income assessed?
Generally, the verification requirements are the same as for any civilian job. Verify current employment income, any retirement income, and or on any VA disability income. Now, VA disability income is key. It's a benefit, so you don't need extra proof it will continue.
It's usually on the COE, right?
Usually, yes. But sometimes, if a claim is very new or still pending right around discharge, it might not be on the COE yet. In those cases, the lender uses VA Form 268937, verification of VA benefits, sends it to the VA, and waits for the completed form back before finalizing the loan. Also, if that form shows a non-service-connected pension or a VA fiduciary is involved, the loan needs prior VA approval.
And judging their job prospects after leaving the military.
That takes real underwriter judgment, especially if they have limited civilian work experience. Do their military skills transfer well to the new job? That's a positive sign. And if a recently discharged vet is going the self-employment route, the regular self-employment guidelines we already talked about apply.
Got it. Let's talk rental income. How does the VA look at income from rental properties?
Okay. Rental income needs careful documentation to show it's likely to continue. There's a concept called rental offset for the vet's prior home. If they move and rent out the old place, the expected rent can offset that mortgage payment under certain conditions.
But it doesn't count as actual income for the new loan.
Exactly. It just cancels out the old payment. Lender checks if the local market supports renting it out. No extra cash reserves needed for this offset scenario. But for general rental property income to count as stable qualifying income, you usually need proof of cash reserves.
Reserves, how much?
Typically, 3 months worth of PITI principal, interest, taxes, insurance for each rental property. Plus, you need the last 2 years of signed tax returns showing that rental income history.
What if the tax returns show a loss?
If there's a net rental loss, even after adding back depreciation, that negative amount gets subtracted from the borrower's total qualifying income. Now, for multi-unit properties where the vet will live in one unit,
Like a duplex or triplex?
right, the reserve requirement is higher, usually 6 months of PITI needed, and the lender wants to see prior landlord experience or proof they're hiring a property manager. In that case, some of the prospective rent from the other units can be counted as income. Usually 75% of the rent from existing leases, or based on the appraiser's opinion of market rent for new construction. But only if they seem like a capable landlord and have those reserves. And one more. Temporary boarders in a single-family home. Renting out a room. Need 2 years of tax returns showing that income. The rental can't change the home's residential character or be more than 25% of the floor space. If the local market supports it, maybe all that income counts. No extra PITI reserves usually needed for just a boarder.
Okay. Are there other sort of miscellaneous income types VA considers?
Yes, quite a few. Alimony, child support, separate maintenance can count if verified, and likely to continue for at least 3 years from closing. Car allowances might offset a car payment. If counted as income, need to check taxes for related expenses to deduct. Other stuff like pensions, non-VA disability, dividends, interest, royalties, trust income generally needs that 3-year likely continuance to count as effective income.
And if it's shorter than 3 years?
Might still be used to offset short-term debts. And remember, VA disability income is the exception. No continuance proof needed for that. Verified public assistance, workers' comp can count if expected to continue 3+ years. Foster care income can help offset higher residual income needs for a larger family.
What income types are usually not counted?
Generally, temporary stuff like VA educational allowances, unemployment pay, though there's an exception for regular seasonal unemployment, and income earned abroad can count if verified, stable, reliable, and convertible to U.S. dollars.
Okay, let's move to taxes and other deductions from income. How are those handled?
Lenders use official IRS and state guidelines to figure out federal, state, local income tax and Social Security deductions, not just what's on one pay stub. For active duty, the state tax shown on the LES is used. Lenders can consider the tax benefits of the mortgage itself, like the interest deduction, by estimating new withholding allowances using a W-4, calculating the adjusted tax on the loan analysis form, and documenting it clearly. Also, mortgage credit certificates, or MCCs, those tax credits some first-time buyers get from state local agencies. The monthly value of that credit can be added to the borrower's gross income for qualifying.
What about other deductions? Job expenses, childcare?
Yep, those are considered too. Unreimbursed job expenses, childcare costs for kids under 12, significant commuting costs, they all factor into the overall financial picture.
Got it. Now, assets. How much cash does a borrower actually need at closing?
They need enough liquid cash for any closing costs, prepaids like escrow or discount points that aren't rolled into the loan. And if the house price is more than the VA's appraised value, they need cash for that difference too.
Does the VA require extra cash reserves, like just sitting in the bank?
Interestingly, no. Not unless they're using rental income to qualify, as we discussed. But having some liquid assets available for emergencies is still seen positively in the overall analysis. Important note. Assets already pledged as collateral for another loan, like a 401k loan, don't count as available assets here.
How are assets verified?
Usually with VA Form 268497A, the verification of deposit, or just the last 2 consecutive monthly bank statements. Same age limits apply as income docs.
What if they need to sell their current house first to qualify?
If proceeds from that sale are needed to pay off debts, for a down payment, restore entitlement, the lender needs proof the sale is complete before closing the VA loan.
Can borrowers use gift funds for closing costs?
Yes, but there are rules. The donor can't be involved in the transaction like the seller or agent. You need a formal gift letter detailing everything amount, donor, borrower, property, stating no repayment is expected, and the lender needs proof the funds were actually transferred to the borrower.
Okay, shifting to the other side of the balance sheet. Debts and obligations. What verification is needed there?
Gotta verify everything. Lenders pull a full credit report, usually all 3 bureaus. If a debt isn't on the report but the borrower mentions it, the lender verifies it directly with the creditor payment amount, balance, history. They also check pay stubs or LES for any allotments being deducted. Any discrepancies need sorting out. Credit reports and verifications have those same age limits, generally 120 days.
And ECOA applies here too, regarding a non-borrowing spouse.
Absolutely. Generally can't pull or consider credit for a spouse not on the loan except for alimony child support or in community property states. But even if not borrowing, a spouse's debts might be considered in the household finances unless they have their own reliable income verified to cover them. Alimony and child support obligations must be verified. Alimony usually reduces the borrower's gross income. Child support is treated as a monthly liability in the debt ratio.
How do lenders decide which debts are significant?
Usually debts with 10 months or more left to pay, or shorter-term debts with really high payments that could squeeze the budget. But even smaller debts might be considered if they impact the ability to cover basic living costs.
What about debts from a divorce?
In non-community property states, if debts were assigned to an ex-spouse in the divorce decree, they generally aren't counted against the borrower, even if the ex isn't paying. If the borrower co-signed a loan for someone else, that payment might be excluded if you can show the other person is reliably paying it and is unlikely to default.
And if selling the current home is required to qualify.
Then the payment on that existing mortgage can often be ignored, assuming the sale proceeds will likely cover it. If they're getting a second mortgage alongside the VA loan, that second payment is definitely a significant debt included in calculations. The key is the vet can't be worse off financially than if it was all one VA loan.
Student loans seem to have specific rules.
They do. If a student loan is deferred for 12 plus months after the VA loan closes, no payment needs to be counted. If it's in repayment or starts within 12 months, you typically use a payment equal to 5% of the balance divided by 12, or the payment shown on the credit report, whichever is higher.
Unless they can prove a lower payment.
Right. If the actual payment is lower, they need a statement from the servicer confirming it. Loans secured by deposits, like a 401k loan. No monthly payment counted, but the asset value is reduced, often calculated as 60% of the balance minus the loan amount, and those open 30-day charge accounts, like store cards. If the balance is usually paid in full monthly and they have funds after closing to keep doing that, no payment is counted. Otherwise, figure 5% of the balance as a monthly payment.
Okay. What about debts owed directly to the federal government? That sounds important.
It's extremely important. Lenders have to check for this. Title searches help find LANICs. Usually that VA Form 268937, verification of VA benefits, isn't needed unless the COE or IRRL case number says so, or if the vet mentions specific situations, like a pending discharge with a disability claim, recently filed claim, or past VA benefits received.
And if they do find a federal debt,
then you need proof it's paid in full, or there's an acceptable repayment plan set up with a promissory note. VA has rules on what's acceptable. And that CAVR system we mentioned earlier, lenders must check it for all borrowers except non-purchasing spouses in community property states. It flags defaults on federal loans, including some VA-related debts.
what happens if VAR shows a problem?
Lender has to verify it with the agency involved and document how it's resolved. A CAIVRS hit doesn't automatically kill the loan unless it's a serious unresolved issue, like an A flag. But it needs full review and justification. If it's a debt from a prior VA loan, the vet can contact the VA Debt Management Center to arrange repayment. And usually, full VA entitlement isn't restored until that debt is paid. Crucially, you can't be a satisfactory credit risk for a new VA loan if you're currently delinquent on any federal debt until it's current or a satisfactory repayment plan is in place.
Makes sense. Okay. Credit history itself, obviously huge. What does the VA focus on here?
Past repayment behavior is seen as the best predictor of future behavior. It's about the overall pattern, not just one or two slip-ups.
Does VA have a minimum credit score?
Nope, no minimum score requirement. But they do have standards for the credit report itself. Lenders get a 3-file merged report or a residential mortgage credit report, RMCR, again, usually not older than 120 days. RMCRs have specific rules about the agency used, how current the creditor info is, what data must be included, repository checks, public records, 24-month history, etc. Rent and prior mortgage payment history are looked at very closely, typically for the last 24 months. Good housing payment history is a huge plus.
What if someone has no traditional credit history?
Not automatically negative. Lender looks for alternative credit records, utility bills, insurance payments, things like that. Any negative credit data. Generally considered okay again after 12 months of solid, timely payments after fixing the derogatory item.
Are there specifics for certain types of negative accounts?
Yes. Medical collections and medical charge-offs. If they haven't led to a judgment or lenders are told to basically ignore them.
Ignore them. Don't need to be paid.
Correct. Don't need payoff, shouldn't hurt the evaluation. But non-medical collections are different. They get considered in the overall credit picture, DTI, residual income. Don't always need payoff, but the underwriter has to address them and explain why other factors outweigh this negative history. Non-medical charge-offs also require the underwriter to address the negative history. Disputed accounts. Lender can consider them if there seems to be a real defense, unless there's already a judgment. Judgments generally must be paid off before closing or be on a timely repayment plan, usually for 12 months satisfactory payments, maybe less if action was immediate.
What if someone pays off old bad debts right before applying? Does that fix the history?
Nope. Paying it off doesn't erase the fact it was paid late or went unpaid. Reestablishing good credit takes time, usually that 12 months of good payments on subsequent debts. Consumer credit counseling plans. Successfully participating can be neutral or even positive. 12 months good payments under the plan, plus agency approval for new credit might show they're now a satisfactory risk.
What about bankruptcy? Is that an automatic no?
Definitely not automatic, but needs careful review. Chapter 7, liquidation. If discharged over 2 years ago, usually disregarded. If discharged 1 and 2 years ago, likely not satisfactory unless they show good credit since and the bankruptcy was due to circumstances truly beyond their control. And divorce usually doesn't count for this. Discharged less than 12 months ago. Generally not satisfactory, with a rare exception for certain documented self-employed business failures.
And Chapter 13, the repayment plan, bankruptcy.
Finishing the plan successfully, good sign of reestablished credit, still in the plan, can get favorable consideration if they've made 12+ months of satisfactory payments and the trustee or judge approves taking on the new mortgage.
Foreclosures, similar story.
Pretty similar. Not automatic disqualification, needs full review. Foreclosure finalized over 2 years ago, generally disregard, finalized 1-2 years ago. Need good credit since and proof it was due to circumstances beyond control. If a foreclosure, deed in lieu, or short sale happened with a bankruptcy, use the later date, bankruptcy discharge or property transfer, to figure out when credit might be reestablished. For deed in lieu or short sale, they also look at how the borrower worked with the servicer. And remember, a foreclosure on a prior VA loan can affect future VA entitlement.
Okay, last big topic. Automated underwriting systems, AUS. How do they fit in?
Right. VA approves certain systems, Freddie Mac's Loan Prospector, LP, Fannie Mae's Desktop Underwriter, DU, and some VA-approved proprietary ones. These systems basically run the numbers against VA standards. They can sometimes allow for less documentation if they give a low-risk rating, like approve or accept.
So the computer approves the loan.
No, that's critical. AUS gives a risk classification, not a final approval. The human underwriter still makes the final call. And accurate data input is absolutely essential. Garbage in, garbage out. Bad data can void the AUS finding and maybe even the VA guarantee.
So the underwriter doesn't need to sign off as much if AUS says accept.
Correct. On the loan analysis form, AVA Form 266393, items 4953 don't need the underwriter's signature for an accept approve, but the overall lender certification is still required. The specific documents needed, and maybe how much is needed, can differ based on the AUS result refer versus accept approve. This affects things like credit report types, handling debt discrepancies, verifying rent history, analyzing non-mortgage debt, mortgage history review, verifying account balances, dealing with derogatory credit, documenting alimony child support.
And it affects income docs, too.
Yes, similar guidelines and potential reductions for non-self-employed and self-employed borrowers. Covers employment gaps, how current previous jobs are verified, VOEs, pay stubs, W-2s, LES, tax info, and verifying assets needed for closing. Key point. AUS helps streamline things, but accurate data and the underwriter's final judgment are still absolutely vital for VA loans.
Wow, okay. That was incredibly detailed. Thanks for breaking all that down.
Yeah.
So just to wrap up, what are the main pillars we've covered for VA credit underwriting?
Sure. We really dug into income analysis, stability, reliability, sufficiency. We looked at verifying and analyzing debts and obligations, including those federal debts and student loans. We talked about assets needed for closing and gift fund rules, and of course spent a lot of time on the crucial review of credit history patterns, specific events like bankruptcy or foreclosure, and how AUS plays a role.
And underlying it all is that VA goal, helping deserving veterans who are at satisfactory credit risks achieve homeownership, right?
Mm-hmm.
With some flexibility built in.
Exactly that. Flexibility and sound judgment are woven throughout the process. Look, the VA Lender's Handbook is incredibly comprehensive. We've really just hit the highlights of the credit underwriting chapter. If you, the listener, have very specific questions or unique situations, definitely dive deeper into the handbook itself. It's the ultimate resource.
Absolutely. So, thinking about this whole complex picture, what single factor do you believe ultimately carries the most weight in deciding if a veteran gets the loan? And maybe more interestingly, why do you think that particular factor is so crucial? Definitely something to ponder. Thanks so much for joining us for this deep dive today.